Hi, this is Mega. Today I will be looking at SPY, which is an ETF that tracks the S&P 500. I wanted to show you some tools that you can use on the short, intermediate, and long term as additional trading techniques. If you're a day trader and you have the time to watch the market continuously, the Relative Strength Index provides great clues as to when to get in long or buy in or sell short. This is the SPY chart for the past 5 days. As you can see, I drew a line here around 70 on the RSI Relative Strength Index. Anything above this I consider overbought. Every time the RSI has gone above 70 last week, anyone who went short would have been in the green within 2 hours. I do realize that the moves are only 2 to 4 points and relatively small, but even if you have $20,000 in an account and can borrow $20,000 on margin, a 1-point move is $40. Compare that to $50 a month you would be making in a treasury bond. If on top of this, you go long each time the market hits overbought or violates this lower trend line and buy into SPY for a small swing, you can do even better. On the intermediate term, for swing traders, I wanted to take a look at the MACD. This stands for Moving Average Convergence Divergence. If we zoom in to the 2-year chart and look at each time the MACD was positive, went above this line, and assume we bought in soon after it became positive and sold soon after it became negative, went below this line, we find we would have been looking at very nice gains since 2007 as opposed to a loss of 50%. As you can see, I highlighted all the times we would have been long in green and all the times we would have been short in orange. And out of 20 trades, only 2 would have been showing a loss, 11 would have showed a gain, and 7 would have been neutral. On the long term, I wanted to draw your attention to something called negative or positive divergence. We use the Relative Strength Index to measure this. If, for instance, the market makes new lows, but the Relative Strength Index does not, as was the case twice during the bear market, the technicals are telling us that the commitment is no longer there to support the selling, and usually a rebound happens in 1 to 2 months' time. This was the case in March of 2008 and March of 2009. What we're seeing now, though, with the SPY making new highs while the RSI does not, is that the commitment is waning behind the buying. This is what we call negative divergence. The conclusion? On the long run, we are likely to see a pullback. On the intermediate to short term, the indicators are neutral. As always, do your own due diligence, use stops, and for more in-depth analysis, join us at megacyclesanalysis.com, and don't forget to check out the comment section.